In this video, we will look at the concept of a scheme of arrangement. Sometimes, a company might find itself in a difficult situation where it cannot fulfill its promises to pay its creditors or certain groups of shareholders. When this happens, they cannot just walk away. Instead, they trigger a legal process known as a scheme of arrangement. This is essentially a settlement process that is monitored by the court to ensure fairness. Under Section 230 of the Companies Act 2013, the company approaches a tribunal called the NCLT. The tribunal then orders a meeting between the company and the people it owes money to. The goal here is to reach a compromise, which usually involves reorganizing the share capital and settling the dues in a way that allows the company to survive. From legal settlements, let's move to a financial solution called loan restructuring. This is a mechanism used when a company is in financial distress but still has a chance to survive. Ideally, a company pays back its loan exactly as agreed, but if they cannot, they ask the bank to change the terms. They might ask to reduce the loan amount, lower the rate of interest, or extend the loan tenure so the monthly payments are smaller. They might even offer to pay the bank with shares of the company instead of cash. This is a win-win situation. The borrower avoids being labeled a defaulter and gets a chance to repair their balance sheet. The lender avoids writing off the money as a total loss and recovers at least a portion of the loan. There is a specific three-step process to make this restructuring happen. The first step is to analyze. The company must look deep into its own books to understand exactly how much debt it has. The second step is engagement. The company meets with the lenders to show them the current financial reality. They cannot hide anything here. The third step is planning. The company must present a concrete business plan. They need to prove to the bank that if the terms are changed, they have a solid strategy to generate enough revenue to meet the new obligations. Now, let us switch gears to a scenario where a company has the opposite problem, having too much cash. We call this the buyback of shares. Imagine a company has excess cash sitting on its balance sheet. Management has three main choices. First, they can use it to expand the business. Second, they can use it to pay off old loans and reduce liability. Third, if they do not have good investment ideas, they can return it to the shareholders. They can do this by paying a dividend, which is a simple payout, or they can choose a buyback. In a buyback, the company offers to buy your shares from you. If you sell, you get cash. If you choose not to sell, your percentage ownership in the company actually increases because there are fewer shares left in the market. You might wonder, what motivates a company to buy its own shares? There are several strategic reasons. First, it gives a value boost if the management feels the stock price is too low and undervalued. Second, it solves an investment void, meaning they have cash but no good projects to invest in. Third, it builds confidence by signaling to the market that the company is strong. Fourth, it acts as a defensive strategy to protect against a takeover. Fifth, it increases leverage by reducing equity. And finally, it helps control dilution, balancing out shares issued to employees. However, a company cannot just wake up and decide to buy back shares. There is a strict eligibility checklist. The money for the buyback must come from the company's reserves and surplus, not from borrowed money. Also, the company must have a clean track record. They should not have defaulted on any debentures, fixed deposits, or existing loans. They also must be up to date on paying dividends. If they meet these criteria, they can proceed using one of three methods. The tender method, where they make an offer to you directly. The open market method, where they buy from the stock exchange like a normal investor. or purchasing from odd lot holders who own very small numbers of shares. Let us visualize the impact of this action. Before the buyback, imagine a pie cut into many small slices. After the buyback, the company removes some slices, so the total number of outstanding shares goes down. This has a mathematical effect on the remaining shares. Even if the company's profit remains the same, the earnings per share or EPS increases because that profit is divided by fewer shares. This usually means the dividend per share will be higher, and consequently the market value per share tends to increase because the company's value is spread over a smaller lot. Sometimes a company decides to leave the public market entirely. This is called delisting. This is the permanent removal of shares from the stock exchange. There are two types. The first is compulsory delisting. This is bad. It happens when a company breaks the rules or fails to comply with regulations and the exchange forces them out as a penalty. The second is voluntary delisting. This is a strategic choice. The company chooses to go private to avoid the costs of compliance, to make mergers easier, or simply to have the freedom to operate without public scrutiny. If a company wants to delist voluntarily, they must follow a process called reverse book building to determine the price. It works like a funnel. First, the promoters set a floor price, which is the minimum they will pay. Then, you and other shareholders bid the price at which you are willing to sell. The promoter then has three options. They can accept the price discovered by the bids, they can reject it and cancel the delisting, or they can make a counter offer. For the delisting to be successful, the promoter's holding must reach 90% of the total shares, and at least 25% of the public shareholders must participate in the process. What rights do you have as a minority shareholder in this situation? The regulations are designed to protect you. First, there is a core right which states that no minority shareholder can be forced to exit at the exact moment of delisting. If you miss the initial offer, you have a residual right. Even after the shares are removed from the exchange, you have the right to sell your shares to the promoters at the established exit price. This window remains valid for exactly 1 year after the delisting date, ensuring you are not left stuck with illiquid shares. Is delisting the end of the road forever? Not necessarily. A company can come back. This is called relisting. However, there is a cooling off period. If the company delisted voluntarily, they must wait 5 years before they can apply to list again. If they were compulsorily delisted due to penalties, the punishment is longer. They must wait 10 years before they can become a public company again. Finally, we will explore a concept called a share swap. This is very common in mergers and acquisitions. Simply put, it is exchanging one set of shares for another. Imagine company A wants to buy company B. Instead of paying cash, company A uses its own stock as currency. They say, for every share of company B you own, we will give you a certain number of shares in company A. Ideally, this results in a handshake where both sets of shareholders become owners of the new merged entity. The key requirement for this to work is an accurate valuation of both companies to calculate a fair swap ratio, ensuring that everyone gets a fair deal.